talking about the importance of creating a tax plan, right? Sort of a timely topic here in the middle of tax season. We outlined the first two steps in that last segment. So the first one is obviously identifying the mix of accounts that you have. What do you have as taxable accounts, or what we like to think of as regular investment accounts that are just maybe in your name or joint name or trust name? What do you have in tax-deferred accounts? How much in those IRAs, those 401ks, 403bs? And then lastly, how much do you have in Roth accounts? Because each one of those is then taxed differently. And then so that leads us to the second step in creating an effective and efficient tax plan. And that is, okay, well, what are the different tax rates that applies, and what type of income do those tax rates apply to? For ordinary income, so that's withdrawals out of those tax-deferred accounts, it's ranges from 10 to 37%. For income that you get in the form of dividends or capital gains, long-term capital gains, then on those taxable accounts, well, then those are subject to much lower tax rates that start at 0%. That's a pretty low tax rate, on up to 20%. So very different tax rates apply depending upon the type of an account and depending upon the type of income or profit that particular account is making, which now gets us to sort of the third piece of creating this effective tax plan, which is really trying to get past some of the things that I think people get hung up on when it comes to taxes and their retirement. I think there seems to be this consensus of, I'm going to have to pay a bunch of taxes on my tax-deferred account, like IRAs, 401ks, and then on those same accounts, I'm also going to have a required minimum distribution. All true statements, but the reality is that when we think about tax-deferred accounts, those help you save for retirement, right? Because a tax-deferred account will let you invest the entire amount into an account versus an after-tax account where you got to go through the tax grinder first, and then with the money that you have left over, okay, fine, then you can fund a taxable account or a Roth account. The fact that you pay those taxes up front, I mean, you effectively have less money to actually invest in those accounts when you start out. So if you're looking to kind of get started on trying to save for retirement, understand the sort of the bonus kicker that comes with saving on a tax-deferred basis, because you don't have to pay the taxes on the money that you put into that right from the very beginning, particularly like when your budget is tight and you're trying to maximize that out, maybe take advantage of all of your employer match to do it on a tax-deferred basis, then you don't have to pay the taxes on that money. According to a study from Morningstar, just to kind of give perspective on that, assuming a equal investment return, so this study assumed 8% return in both cases, and said, okay, if you put $5,000 in a tax-deferred account, right, then you get the full $5,000 in that account. After 40 years, that $5,000, assuming that 8% return, grows to over $108,000. So that's pretty cool. Now, if you put it in a taxable account or a Roth account, well, guess what? You got to pay the taxes on that. And so now you've got less money invested. And so that less money invested at the very, very beginning only grows to about $85,000. So that's a 25% difference, which if you expand that over the course of all of your savings that you're going to do, it can certainly add up. Now, understand the reality is that is then taxable as you use it. But that's why having a good tax plan is a pretty good idea, is to try and figure out ways to minimize that. I guess I would say I'd rather have you have a solid tax plan with more money than less money in the bank, I suppose, is kind of where I come down on that. The required minimum distribution is another item that, I got the must take money out. Well, if you're retired, aren't you taking money out of the accounts anyway, right? I mean, there's so many different ads out there that push this notion of, you've got to become tax-free, or, the required minimum distribution is going to be a big number. It's really not. When you do the math, in year one, it's like 3.65% of the account. So if you're retired and, like using your accounts to generate income in retirement, which the vast majority of people do, chances are, if you're doing kind of the standard 4% withdrawal rate kind of concept, you're satisfying your required minimum distribution. So those are some important takeaways, if you will, in order to get to establishing sort of this tax plan. So the first three steps are knowing the difference, right, between the different types of accounts, knowing the different tax rates that apply. And then third, don't get too hung up on the taxes that are going to apply. So once you've sort of done those first three parts, okay, I said there was 4 steps to this. Those first 3 are crucially important. It's time then, once you have all of that information, it's time to transition to the last part, which is actually formalizing your particular tax plan. And here's where you're going to need some software to do it. Because in order to really understand and accurately calculate out your tax picture, you probably need some software to run it. I mean, if you've ever tried to do the calculation by hand on the taxation of your Social Security, I wish you well. I used to do that before, we had all this fancy software and whatnot in the office. And it was like a full sheet. And it had like 20 different steps you had to go through in order to calculate it. So I don't encourage that approach. Having actual tax software really is the way to ultimately get to that 4th and final step of creating an effective tax plan. And certainly that's one of the reasons why over 20 years ago we started a tax preparation service at Nelson Financial Planning that is exclusively reserved for our retired or nearly retired clients to really lean into this tax planning concept, because you can certainly add a lot of value and insight by looking at the actual details of a tax return to determine sort of where to create that greatest efficiency. And in today's world, right, calculating all of that, you probably want to use an actual tax return software. So it's those types of things that we do every day for our clients at Nelson Financial Planning, and I believe really underscores the importance and the value of having a tax plan for retirement. So certainly some important discussions, particularly this time of year as it relates to tax planning. We'll shift gears. This next topic really kind of freaked me out. It should probably freak you out too. These days, of course, everybody's talking about AI and things like that. But the reality is that AI is also being used by criminals as well. And if you've driven the 408 just any time over the past week or so, there's actually, like the signs as you're going through that say congestion ahead, and they pretty much always say congestion ahead. But they are now saying, so congestion ahead comes up, and I'm like, I can see that. A bunch of people around me. But they're also saying, warning about ticket scams and not to click on the text that you got that says, hey, you owe a toll. And that's all part of, unfortunately, what's happening out there with AI. And we're not just using AI, right, to help our productivity and to do things maybe a little bit easier for us, but the criminals are too. And so we've got some concrete suggestions that we're going to be going over with you here on the program in our next segment, because there really is a lot to unpack on this. And this technology is moving very, very quickly, and it is allowing these scam artists to make much more personalized attacks to part your money from you on an illegal basis. So stay tuned with us through the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning for much more on that topic.